Netherlands is a very nice example, I think, to look at the importance to coordinate any dismissal agreement also with a tax advisor when someone has worked internationally. And I will not give you a spoiler. I want to give you a spoiler alert because we will address that later in more detail. But I would like to start this overview of a little bit messy processes by the Dutch tax authorities with a slogan that they used in an advertisement campaign a couple of years ago. I didn't see it coming back in the last couple of months, maybe years, but they had a slogan where they said, we can't make it any more fun, we can make things easier. And I think at the end of my talk, I want you to be the judge of whether this is actually true or not. A couple of things I want to address. We will discuss, of course, the international allocation rules as they apply in the Netherlands, but I also want to give you a little bit of background on international taxation in general when it comes to employment, because that's a little bit like the hanger that you use to use the other parts of knowledge that we will need to share. When you look at tax treaties, one thing that really comes to mind is the model that the OECD has created, and that's often used by many Western countries as a basis for a tax treaty. Well, why do we need a tax treaty? There's two different concepts in tax law. One is tax residence, the other is non-residents of a country. Residents are always taxed on their worldwide income, non-residents on income from sources from a particular country, and you will see if a resident of, say, France goes working in Italy, and then Italy will claim taxation rights and France will claim taxation rights, and the treaty will need to work out the differences between those two taxation rights. So what the treaty basically does is it tells which country is allowed to levy tax on that particular element of income. It also says that another country needs to do something. And we see a difference there in terms of a treaty. When the treaty says that the country of source, like in the example that I just used, Italy, is not allowed to tax the income, well, the country simply does not tax the income. But when the taxation right is allocated to the country of source, the country of residence needs to step back. And they can do that in two different ways. One is by giving, well, this is all very generic, so that there will be some differences per country, but in general terms, they can do that in two ways. One is by giving a credit, and when you give a credit, you basically deduct the foreign tax from your own tax. So the end result, the bottom line for the employee in this example is the same. And the other way that you can use is exemption with progression, and that creates possibilities for tax planning, because the relief may be bigger than the tax you pay abroad. And that's when you can use it, it could even make something positive out of a bad situation for an employee. Then we need to look at how income is allocated between two countries. Most important, I think, is to be aware of what's known as the 183-day rule. And most of my clients, when they first talk about it, they simply count days and say, oh, I stay under 183 days, so I'm fine. It works a little bit different. The general rule in a tax treaty is that you're taxed in the country where you work, but when you have someone that works in 10 countries in a year, of course, it's very difficult to administer. So that's why there's an exception to this general rule, and exception applies when you are in a country for less than 183 days in a certain reference period, and the remuneration is not paid by or on behalf of an employer in that country, plus the cost is not cross-charged to a permanent establishment of the employer in that country. So that's kind of when you look at what we currently use as a very good starting point is, of course, born in the foreign country where you work, then most likely you will have to pay tax when the relationship with the company there qualifies as an employment relationship. Different rules apply for people that are directors. For directors, the general rule is that when income is derived from a directorship, that income is always taxed in the country where the company is established. That's done with the background that a director can determine his own place of work, and therefore they want to avoid unnecessary tax planning. More recent tax treaties have small exemptions to this general rule, but it's still the most common way to allocate income from a director. Then we come a little bit more towards the correlation between the severance agreement that's being prepared and tax treatment. When you look at elements you put in an agreement, there can be a variety of things that an individual can be reimbursed for at the moment of a dismissal. One that I don't come across a lot, but I would love to see it once and maybe even discuss it also in a bit more detail with the tax authorities, is anything that you get as a compensation for damages in case of unfair treatment, anything like that. That's not part of economic activities whatsoever. You can argue that it's tax-free and therefore it doesn't hit any tax treaty, but it's highly exceptional. In Dutch case law, you see a couple of claims by people that actually think that they are entitled to such part of tax-free reimbursement, and in essence, most of the requests are being denied. So it's a bit rare. But when you then look at elements like vacation pay, severance pay, bonuses, etc., they will all be governed by the two articles that I just mentioned, Article 15 and 16 from the OECD model. But also, severance pay can be considered a pension in exceptional cases, and that's mainly the case when someone gets a certain amount of money to cover the period until retirement. But for all these elements, it's very important how it's drafted in the agreement. It's very difficult for a tax lawyer to say, oh no, this was presented as a bonus, but it should have been pension. And that's basically starting with a little bit of disadvantage when you enter into a negotiation. Just for my own country, in the Netherlands, we have an expat ruling that's called the 30% ruling. Well, actually, it's 27% right now, but I still prefer to call it 30% because I hope that someone in Dutch politics will change his mind and change it back to 30 again. But under that ruling, severance pay is not subject to this benefit. So 100% of severance pay is taxed in the Netherlands, but if it would be a bonus, for example, for an expat that qualifies under this ruling, then only 70% of this payment could be subject to tax, depending on a couple of other circumstances. Now comes the interesting part, where I think that kind of shows that I'm not a big fan of Dutch lawmakers in general. The whole allocation rules have been quite messy in the past. We came from a situation before 2004 where there was no guidance how to treat severance payments of people that worked internationally. So what you did was pay very good attention to how you draft an agreement, preferably have an upfront discussion with a tax inspector, and then work out the exact details and treatment. Only in 2004, the Dutch Supreme Court decided for the first time on the international allocation, and they came with what they thought were very clear rules. They said, well, we need to allocate it. When someone had an international career, we need to allocate it in some way to this career. And what we find reasonable is to look at the prior 4 calendar years plus the current calendar year. So that means that if you terminate an international executive, for example, this year, say on July 1, You look at the career from January 1, 21 up to July 1, and on that basis you determine the allocation of taxing rights. We were pretty unique with that in the Netherlands. So you saw an international tax. There's always another country that also looks at this. So it's born to be not very successful. Second requirement that the Dutch authorities had in this approach was, they said, well, we think that it can be allocated to a foreign country, but there has to be a cross-charge, of course, as well. And they left it basically with that rather vague definition. That definition of cross-charge was then discussed in 2006, where it was made a bit more obvious, like when is the cost cross-charged to a foreign entity. Then it became clear you should not do this as part of a general management fee. You have to be as specific as possible. And you can do that on the basis of, say, a commercial rate of someone or any way how you usually cross-charged cost. But we always recommend clients to be extremely specific, simply saying salary cost or severance cost of Mr. So-and-so for this and this reason, just to avoid any misinterpretation between two countries. So that was a little clarification that we got in 2006 when costs will be borne by a foreign entity. In 2008, there was a different element that was further clarified. And that element, you saw that we have a very hypothetical allocation that the Supreme Court used in the Netherlands based on the 4 years plus. Then you got a discussion like, well, if the cross-charge does not really match the 4 year plus, how do you deal with that then? And then basically the verdict of the Supreme Court said, well, for a resident, you cannot give a higher relief for the avoidance of double tax than based on the 4 years plus 1, regardless the cross-charge. So as long as there is a cross-charge up to the level of the percentage allocable to the foreign country, you can claim that relief. But when the cross-charge is more, you cannot get a bigger relief. Just when the cross-charge is less than what it should be under the 4 plus 1, then you have a smaller relief or no relief. And they also did it the other way around for non-residents, where they said, like, well, if you're non-resident of the Netherlands, then the reverse basically applies. So with that, we continue to struggle a little bit in practice, complicated, but was doable as long as you did not look at what happened in a foreign country. Then we came to 14, and in 2014 was the first time that the OECD issued a commentary on how to treat severance pay under a tax treaty. And basically what the OECD said was, well, we think you should allocate over the total career with the group that you are made redundant from. And then the severance pay is taxed in the same ratio that the employment income was taxed during that career. But we can imagine that that can be quite difficult in certain cases. And when that's the case, we only look at the last 12 months. So it's kind of simple guidance with one important deviation, I think, from what we saw in the Dutch interpretation. The OECD did not require a cross-charge. So they were very straightforward and a fairly simplistic approach. Then we saw a brilliant approach by the Dutch tax authorities. I just mentioned that the general rule, according to the OECD, was look at the total career. When it's too complicated, look at the last 12 months. the Dutch tax authorities interpreted that the other way around, where they said, oh, we need to look at the last 12 months of unemployment, because the whole career, that will be kind of exceptional, because no one will really be able to keep track of that. And it took them 7 years until they found out that they were kind of alone in that interpretation. And then they decided to switch basically also to an allocation on the basis of a full career. In October 22, something else happened with the Dutch Supreme Court on a different matter, not relating to severance pay. The question came up what the value is of an OECD commentary to tax treaties that were already in existence before the commentary is revised. And then the Supreme Court said, well, I think that the commentary cannot have a big impact on tax treaties that have already been negotiated, because then the OECD is going to take the seat of the lawmaker, basically, and overrule what the lawmaker says. Now, yeah, it's pretty plausible, but it also puts the Netherlands in another difficult position when it comes to the allocation of taxation rights. But they were pretty, oh, I can go one back. But then what in the end happened was that a new directive was published, and that's what's currently in place. And that makes it fairly complicated to see how you treat severance pay internationally. What they basically do is say, well, any agreement that was in place before the OECD commentary was published, that's subject to the 4+1 allocation, provided it doesn't create any tax windfalls or unnecessary double taxation, because in that case we do follow the OECD commentary, and for newer cases the OECD commentary is followed, and the allocation takes place on the last 12 months. So that now means that for every case you need to look at the date on which the tax treaty was signed. You of course need to double check the protocol if after the OECD model commentary was revised, anything has been said that the commentary would be followed. So it makes it very messy, also given the fact that the cross-charge is required under the old treaties, but not under the new treaties. So it's nice to be an advisor on this in these times. I mean, we don't live on simplicity, but I don't feel really proud of this piece of legislation and regulation in the Netherlands, as it's not really how I think it should be, to give certainty to a taxpayer and also equal treatment in case of dismissal of a group of international people.